All right. So, legal expenses occurred in defense of civil or criminal procedures. So, a taxpayer must be directly related to the trade or business in order to be part of it. So, if there are legal expenses here, that's kind of what I was just talking about, then the legal fees would be deductible. The fine, still, if they were found guilty, still not deductible, but the legal expenses would be. Ordinary, necessary, incurred with the train of business, with a rental property held for all deductible legal expenses would be deductible from AGI. So legal expenses can be. Anything dealing with an illegal, no. Anything illegal, just no. All right? Now, this is what's interesting. The second sentence or bullet point. Take a second to read that. Now, does anybody know why, if you're trafficking a controlled substance, the cost of goods sold can be deducted from gross income? Why is that? What else has to be included? Huh? You have to include your income. Even though you're trafficking a controlled substance that may or may not be illegal, you technically still have to include the income of the illegal substance. And therefore, you can deduct the cost of goods sold, which is an expense. So that's the only expense you can deduct in illegal substances. And in some states, you cannot go after somebody for declaring their income in illegal activity on their taxes. Don't ask me how that works. I don't know how that works. But why would you? You cannot go after somebody for declaring illegal income.
So anyone cannot?
The police cannot go after someone for declaring illegal activity. Now, how they say it's illegal, my guess is they don't. My guess is they say cash, right? Income from operations, cost of goods sold. But my guess is they probably have an idea, is what I'm thinking, that, right, that the person's. So why would you declare such cash on your taxes and such cost of goods sold if it's illegal? There is actually an answer. Why would you declare that on your taxes?
If you get arrested.
Because you'd get arrested?
You've been arrested.
No, because you've been arrested.
So if he declares income, if he could declare the cost of goods sold.
Okay. There's more to it. It's not because they have been in the past. Because basically, then, if you have been in the past and you're saying you're still doing it. So why?
If you got arrested this year for
Okay.
illegal activity.
But why would you? What if you've never been arrested, or you have been arrested and they think you're clean? Why would you include income from an illegal activity and cost of goods sold on your taxes? Even though,
Because
what?
You have to pay taxes.
No,
Pay taxes.
because you have to pay taxes. And if you do get caught, now not only are you in trouble for controlled substance, whatever you're doing, but tax evasion. And you owe taxes and tax penalties for all the years of the income that you did not pay taxes. So I know that sounds like a secondary, but think of how much money some people make in these wonderful illegal crimes, right? So they've made all this money. Now they have to pay taxes on all this money that they spent, and they're in jail. So when they get out of jail, they owe millions in taxes. And that has happened. They got out of jail and they owe all this money in taxes, and it's because of tax evasion.
So wasn't that the way they got Al Capone?
I don't know how they
I
got
thought
that.
they got him on tax evasion.
Though that could have been. That could have been. No, I do actually. Now that you said that, they did get him on tax evasion. Was that for, or was it for something else that he didn't do with a legit business?
I think it was because of all his bootlegging activities.
Okay, well, that could make sense. All right, we kind of mentioned this. So there's no business deduction allowed for any type of political payments. Exceptions are allowed for lobbying, all right? And that's lobbying in generalness, all right? And it is to monitor legislation. In-house expenses, they have to be limited to $2,000. Before 2018, exemption was provided for influence local legislation. Okay, that's not anymore. So Dr. Payne made political contributions to the state Senate. He made these contributions to encourage the state senators to support a new bill that would help the dental. So we know that these would not be beneficial, and therefore he cannot deduct them. Now, what about the contribution he made to the dental society? Can he deduct that? Part of it. All right. The trade association estimates that 70% of their dues are allocated to lobbying. So therefore, he can only, as a result of his deduction, he is limited to $3,000. He can only deduct 30% of it. Now, normally, like depending on what you're doing, his was to society, all right? If they would have been 100% lobbying, then he couldn't do it. All right, now we got this wonderful thing called the excessive executive compensation. So I don't know if you knew this, but deduction for compensation to CEOs is limited to $1 million. Now they get away with doing this other ways, but it covers the CEO, the CFO, and the other 3 highly compensated employees. Anyone who is covered employee after 2016 will be subject to the rule for other years. How do you think they get away with paying them more money?
Stock options?
Exactly. So they give them stock options. All right. So this applies to compensations, commissions based on individual employments, and performance based tied to overall company. So before 2018, the $1 trillion limit excluded commissions and performance based. Now it doesn't. So contracts in place before are grandfathered in. So there's a $1 trillion limit that used to not exclude these. Now it does. So these performance-based commissions and all that, those now hit this $1 trillion, which I think is ridiculous. But that will include everything else. All right. So now they are limited on this gigantic, enormous amount. So there is some limit that I don't think anybody should hit.
But $1 trillion? I mean, that's 1,000 billion?
What did I say? No, before, no, wait a minute. No, it said million. Did I just say trillion?
You just said trillion several times.
Where did that even come in my head? All right, so the billion excluded, huh? No, it's like, that's what I was saying. Who exists that amount of money? I don't know where I got that. But the million excluded commissions, now it includes it, but it does not include the stock, but it includes any type of cash-based commissions. So commissions based on employee performance or anything tied to that. So they're $1 million, because we all know there's a lot of CFOs and CEOs that make more than $1 million a year. All right, so investigation expenses. Now this one I think is kind of interesting, because this is when you're looking into whether or not you want to go into this business and how these expenses you can put onto your Schedule C. So investigation expense to determine the feasibility of doing a new business, going into a new business. It includes all the cost of going into it. So they're treated on an expense as an expense depending on the type of business you are already in, the type of investigation or the nature of the business you're investigating, the extent to which you do it, and then whether or not you decide to do it, which I think is kind of interesting. So if you're in the same type of business, then the expenses are deductible. All right, so if it's the same or similar, but you're looking at expanding it, then you can deduct those expenses in the same year. If it's not the same business, then it depends on if it's acquired. If it's not acquired, you can't deduct them. So if you do all this expense and you investigate something, you decide not to do it, tough. If you do all the expenses and you decide to do it, then the investigation can be part of your startup expenditures. All right, you also may elect to use the first $5,000 as expenses currently, and the excess can be amortized over, I think it's 180 months. So you're really out of luck if you just decide not to do it. Which, I don't know, I feel kind of like takes part of the investigation part as the gamble. Like, to me, if you're investigating doing a new business, there should be some type of, when they're looking at people and trying to get people to do new businesses, there should be some type of benefit to you to investigate something. But I guess I see the downside in that there'd be people out there investigating all sorts of wacky type ideas and then wanting to write it off on their taxes. All right, so Dr. Payne believes that his skills can be used around dental practice where revenue is declining. So he investigates Teeth Restoration, a local dentist practice that is for sale, and he has $6,000 in expenses, and he decides it's not a good investment. So can he deduct it?
Yes.
Yes. All right, he can because it's the same type of business that he is already in, which is good because he spent $6,000 on it. All right, hobby losses. You guys should be happy. And this one's interesting, and I didn't get through this. Hobby losses are, unless I drastically miss something, hobby losses are no longer deductible. So, give me 1 second. They're talking about the income. Okay. So hobby losses are things that you're entered into for the purpose of having fun. All right. You're not in it to make money. So that's the whole point. If the activity is not engaged to make money, then it's considered a hobby. So a lot of people, for example, having a horse for show is fun. If the horse starts making you money, it's profit. All right. So expenses are deductible only to the extent that you are making money. You're not going to show a loss. All right. The activity, if it's entered into profit, can be deducted expenses for AGI, even excess income. Often it's very difficult to determine if something is a hobby or if it's an income. If activity shows a profit for more than 3 years out of 5, then you have to assume it's now a business and not a hobby. And the burden of proof actually shifts to the IRS. Otherwise, the taxpayer has the burden of proof. Right? So normally the taxpayer has it, but in this case, once it goes 3 out of 5 years, then the burden of proof is the IRS. So this is kind of a little bit of an example. So notice we had income of 500, then we lost 500, then we had 500, then we lost 1,000. So it's all hobby, 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 hobby. But then when we get to 2015, 3 out of the last 5 years we made money. Doesn't matter that we lost a lot of money. 3 out of the last 5 years we made money. So now it's no longer a hobby. And now it's back to a hobby in 2016. And then 2017, it's still back to income. So hobby losses are one of those things where, how often do you think this is reported wrong?
Frequently,
Yeah, and do you think it's reported as income or a hobby?
you report it as it's reported as a business.
You think, or do you think?
So they can deduct stuff?
No, I think people probably report it as a hobby so they don't show income.
Oh, I see.
I didn't know anything about that.
Right. So,
I haven't reported anything.
as what?
For myself, I haven't reported anything.
You haven't reported anything, right. And I think also there are a lot of people that do like craft fairs, different things like that they consider is kind of fun. Yeah, they're making money, but I don't know that they think they're really making any money. okay? And honestly, they're probably not. I mean, we used to give my dad trouble that he should be a handyman. I mean, because first of all, he's retired, he can fix anything, but he said he takes so much time to do things that he would lose money, honestly. And honestly, he probably would. But like, I mean, okay, so he's like, I'd probably lose money. If he took how much time and put an hourly rate to it, he would lose money.
But he's happy doing that.
He's happy to doing that, exactly. I mean, my old house had, every room had hardwood floors put in it. He did them all, you know, he's done everything. But he just kind of just does it, you know, stops, has a beer, does it, you know, kind of works at his own pace. And so he would have gains because people would pay him. But if you wouldn't take into account his hours, it would look great.
His expenses still cost, he might need a
Expenses
pedestal
take,
or
exactly. And
something like that, and I
you
didn't
would
know,
have losses.
or
Right.
like I didn't know that, and I didn't.
And if you take into account the people at the craft fairs, depending on what tables you go by, they love doing what they're doing. And they're probably doing some of those things that sitting in front of the TV. Some might have little kids or grandkids, are all doing all these little things. They come up with it, they go sell it, they're making money. But their time isn't accounted for, right? So they're making money based on their expenses, but not necessarily based on the fact that when you and I work, we're also being paid for our time. And time's not being accounted for. So, in general, I think a lot of people don't put forth what their hobby is, and their income is showing gain, but maybe if they classified it with everything in there, it wouldn't be. So it's interesting you said that, James, that they put it as income. Maybe they do, and maybe it wouldn't be income if they classified all their expenses in there truly as expenses also.
So let's say they have a hobby, they make $1,000, but their expenses are 800 or
Right.
something like that. So can they?
That would be 200 then.
200, but if they're considering it just a hobby, they can't deduct the.
No, they can. So
Okay.
that, yes, so that would be income loss. So you can deduct your expenses in a hobby. Yeah,
Okay.
yeah. So you can do that. And so, but you just can't go negative. Like
So
you
they
can't
have more
report.
expenses than income.
Right, so on your taxes, you can't show a negative, you cannot show a loss with a hobby and get a benefit from it. You can show a loss with a business and get a benefit from it. So a Schedule C can show negative, and you will get a benefit as reducing your taxable income. Okay, you're reducing your AGI. A hobby loss cannot reduce your taxable income.
So the loss is not retained for the next year.
Right, yeah.
Is to stay with corporations?
Corporations,
Big companies?
big companies with regard to net income or taxable
I
income.
mean, for the loss, they can retain the loss.
Well, their loss is rolled into their retained earnings, so it's a little bit different with corporations. All right, if it's deemed a hobby, can only deduct expenses to the point of their activity. They cannot have any type of hobby loss, but they can if it's deemed, if it's deductible from AGI. It's a miscellaneous income subject to AGI, which we don't have anymore. All right, so that's what I was talking about before. So expenses are deductible from AGI. So this is the weird part that I was talking about before. You include your hobby income, but there are no longer any miscellaneous itemized deductions necessarily. So expenses that are deductible without regard to profit motive are deductible in full. That doesn't matter. So this one is a little weird. Order in which hobby expenses are deductible. First, you have your mortgage, like if you're doing things are at home, and then expenses that are not adjusted or maintenance, and then the expenses. A lot of people, that you can deduct portions of your home, okay, that's what they're talking about there. You'd have to allocate them out just like you would a business. But there are no miscellaneous expenses that are like that anymore. So you're really kind of at a disadvantage with hobby income now versus including it with your income. All right, so example of hobby expenses. This is just going through. And this is what they were talking about with regard to the first thing you do is you take into account your interest in your house, if you're using your house. So this person sells horses. So $6,000 of interest is first. You can deduct all your interest. If that much allocated, it's probably on the barn. Then you have taxes probably related to the barn. You have vet bills, and you have the feed that goes with it. So then you have $1,000 of depreciation on the barn, but your income is $15,500, so you have to limit your expenses to $15,500, so you would stop at depreciation. Okay, the reason that they're allocated in this order is this, because in the event that you are capped out, you can't leave this interest for the end and move that over to your itemized deductions. You have to allocate that to the hobby loss first, because that interest is directly related to the hobby. So that interest on the barn has to go to the hobby. You can't then use that interest on your house, on your itemized deductions also. So if you're going to use it on your hobby, you got to use it. You can't use it on your other. So that's why they put them in order. 1, interest and taxes, then direct expenses related to your hobby, 3rd, depreciation. And why is depreciation 3rd? Because you can't use depreciation anywhere else but businesses and hobby. You can't use it on your house or your itemized deductions.
So I guess I don't quite understand the interest, you said you're paying interest on the barn.
Okay.
Wouldn't it be more like a mortgage or something?
It would. It'd be a mortgage on the barn,
Okay.
okay? Just like you would have a house. But you have income related to the horses, which is a hobby. So if you're trying to make that income not be taxable, you would take the mortgage from the barn, because it's directly related to the horses, and reduce your hobby. And we're talking obviously a nice barn if you have a mortgage on it. But obviously to build a barn, you might have to, go get a home equity line or something. All right, so I believe, and I can't remember for sure, I think this is the last part of this chapter, but it's rental homes. All right, this is Schedule E. Rental homes are on Schedule E. And when we're looking at rental homes, when you start looking at your homework, there's 2 different ways to look at rental homes. One is that you rent it all, or the other part is you rent it and you use it. All right? Obviously, the easiest way to do it is just rent it. All right? Because then it's rented, you don't have to worry about it. But that's not how we always do it. So you may have both personal and rental use of the home. You can deduct the rental expenses, but if you also use it for personal reasons, then you have to allocate them out. All right? And the determination of the vacation home is if a dependent or relative is using it, has to be taken into account too. So first of all, the easy part. If it's rented for less than 15 days a year, you don't have to include any rent. All right? So mortgage, interest, and full, all considered personal. So I don't know if you guys have ever heard about this, and I'm not saying, because this conflicts with the fact that what's considered income, all income, right? Here it says 15 days, no gross income is recognized. It conflicts with all income, right? But down around Augusta, Georgia, there's something called the Masters, okay? And when the Masters comes into town, there is not enough places for people to stay. And one of our reps moved into a place down right by there in Augusta, literally a month before the Masters. And someone told her, don't unpack, or what they said is unpack, but don't get yourself moved in. You need to rent it out. You will pay for at least a month's mortgage, if not 2, if you rent it out for that week. And she did it. Less than 15 days. I don't know what she did. I did not want to know. Okay, it's just better. Even though I didn't do her taxes, it's just better if I don't know. But she's not an accountant. She's a book rep. Okay, so not held by any CPA standard. But it's definitely conflicting when it says no gross income recognized, no expenses recognized. So she couldn't deduct any expenses it took to clean her house back up. However, golf renters are a little bit different than when you rent your house out to like baseball people or Airbnb or anything like that. They tend to be a little bit better. I'm not saying they were great. And when it says under gross income is all income received, right? To me, all income received is someone's renting your house out, you include it. Here it says no gross income is recognized. So, but she made 2 months worth of a mortgage for 1 week. And she wasn't even in it. She never stayed one night in it. I mean, that's the best way to rent it out if you think about it. You never stayed one night. You just kind of moved in, didn't put anything expensive or personal really up, so she didn't have to worry about that, and rented it, and then she moved in. She stayed at a friend's house. She was fine. She said she couldn't stay at a hotel because there were no hotels. But so 15 or more days depends on how you're treating the house. So if your primary purpose is renting, so we get a place down at Gulf Shores, closest place around us, your whole purpose probably is going to be to rent it, maybe, all right, and then you're going to use it for several weeks out of the year or even the winter months, right? But the purpose is to rent it. If it's rented for more than 15 days and personal use days are not greater than 14 days or 10% of the rental days, you allocate the expenses between personal and rented days, all right? And you can deduct rental expenses even if you lose money. Now notice it says 15 days or more, which you hope you do, and personal use days not more than the greater of 14 or 10% of rental. So that helps. So if you rent it for 90 days, 10% of that is 9. But if you end up renting it for 6 months, 10% of that could still be your winter months. So you go up with the longer that you rent it. So you can be more than 14 days, right? And then you just allocate the expenses between the two. All right, personal and rental, you're equal, not just rental. If it's rented for more than 15 days and personal days exceed 14 or 10%, then you treat it as a hobby. Rental days are deducted in a 3-step process. So, first of all, the easiest way to do it is just rent it. The second easiest way to do it is to treat it as a rental and just keep your personal use days less than 10%. Okay? Then there's this way. So, how do we do that? All right, so we have a couple scenarios. We'll have an example we walk through. It was easier to do it this way than do a problem because we had so much. So, 7 days or less is not significant. 18 days or less, not significant because we rented it 200 days. 25 days is significant. All right, and that's our example of personal use. So we rented it 200 days, we were over. Here, we rented it 100 days. 14 days is still not significant because 14 days is our trigger. You can always rent for 14. You can always have it for 14 days on a rental home. So how are we going to look at things? Well, allocation between personal and rental, we got to look at the mortgage, interest, and real estate taxes. That always comes first. We have 2 different ways of looking at it. We have the IRS way and we have the court way. All right? Other expenses are always allocated based on days. How do you decide between the IRS and the courts? The problem's going to tell you. All right? IRS is one allocation way and courts are the other. Treatment of income and vacation home. So the rental income is included in gross income and the rental expenses are on Schedule E for AGI. We use Form Schedule E. Everything goes on there. It all flows for AGI. All right? Primary use, taxes are deductible from AGI. All right? Because why? They go on your Schedule A. If it's personal use and rental, mortgage and taxables are from AGI. All right? The personal portion and other than that are non-deductible. So, rental part are going to be on your Schedule E, personal part from AGI. And what we're going to do is we got to allocate how much goes on each form. All right. Did it? Hang on a second. It did not talk about. All right, so I thought it just gave me examples. So when you're looking at the rental, court days is going to look exactly as if you said you sat there and if you rented the place for 30 days, all right, and it was rented for 30 days and you used it for 20, then you would look at it as something like 30 out of 50. And the rest of the time it was empty, right? So it'd be 30 over 50. That would be the court's way of looking at it. The IRS way of looking at it would be 30 out of, I just got those backwards. This is the IRS way, sorry. This is the court. Right? So they're gonna look at it based on the number of days. Now, when this is looking at for tax purposes, taxes and interest. The actual expenses related are always going to be based on actual days. So those will always be like the 30 out of 50. Now, if you rented it the whole year, it will be 365. But in this example, we only rented it 50 days. It was only used 50 days. So we rented it 30 out of 50 days, so my expenses are multiplied by 30 out of 50. 20 days was personal use. Here, it was rented 30 out of 50 days. I'm going to take my taxes and interest times 30 out of 50. That's what goes on my Schedule E. All right? For the court's purposes, it's 30 out of 365. Why? It's going to take a much smaller number, right? Much smaller number. The IRS, when they do 30 out of 50, guess what? A much bigger number is taxed. That's why the IRS likes that smaller. They get a much bigger taxable number. There is a tax problem. There is a problem you have for homework, and that's why I wanted you to see the difference. So when you're doing the problem, the biggest confusion on the problem for homework is when you're going through it is to make sure you know what it's asking you. All right? When you look at itemized deductions, you look at if you have $10,000 of itemized deductions, and then they're trying to ask you, what do you include? Well, if I have 10,000 of itemized deductions, whatever I calculate, for the court, let's say the IRS, whatever I calculate for the IRS, I'm going to take just the interest and taxes. Well, guess what? All the other expenses aren't going to be included in my itemized deductions. That's just going to be this. So I'm going to multiply my itemized deductions times that, my 30 out of 50. Whatever that number is that I get, then I'm going to subtract that to get my new itemized deduction number. That's what I put on my taxes, whereas the number I just got would be what I would subtract from my income that I got from my rental. Because that would be how much I'd be able to take out for my taxes and interest. So I can get a number to it if it helps you guys a little bit more. So if I have $10,000 in itemized expenses, oh my God, I got the world's smallest calculator. If I have $10,000 in itemized expenses and I'm using the IRS approach and I multiply it 30 and divide by 50 days, I used it 30 out of 50 days. That gives me $6,000. That means $6,000 of that is going to be allocated, of that expense is going to be allocated to rental income. Let's say my rental income was $9,000. Of that $10,000 in itemized deductions, $6,000 of that is going to reduce my rental income. That means I can't include $6,000 of it on my Schedule A. I only can include $4,000 because $6,000 went to my Schedule E, $4,000 can go to my Schedule A. You can only include $10,000. If I had $10,000 of itemized deductions, $6,000 went to the Schedule E, $4,000 went to the Schedule A. So now on my rental income, I had $9,000 of rental income, I had $6,000 of interest and taxes, and then my other thing, maybe I had $3,000 of miscellaneous expenses, so I take 3,000 times 30 divided by 50, and that would be $1,800. So in the end, I had $1,200 of rental income. Now, the other amount, the other $1,200 of expenses, nothing happens to them. Why? Because they're personal. Personal expenses don't get written off. Those were just expenses I used when I was at my condo or whatever else I use. Interest and taxes you get to deduct. Personal expenses you do not. That's using the IRS approach. If we use the court approach, it's going to be a lot less, right? Because we'd be using 30 over 365. Does that make a little bit of sense? I do apologize. I honestly thought that there was an example. I don't know if I hit delete or there just wasn't one to begin with. So let me back up just a couple slides. I backed it up already. Okay. No deduction is allowed if you pay someone else's expenses. I don't know if you knew that or not. Some people don't understand that. But if you pay someone else's expenses for them to help them out, including taxes, you do not get to deduct it. The only exception is for medical. If you pay for someone else's medical expenses for a dependent, you can deduct those expenses. I was having that wonderful experience today as my son, who's up in college, went to his first ER visit, not at home. Everything's fine, but it still was the pain in the butt having him visit it for the first time and trying to figure out how to pay for that. All right, disallowance, same thing we had before. Personal expenses are not deductible. All right, and then disallowance of deductions for capital expenditures. You are not allowed for payments for new buildings, improvements, or betterments to increase the property value. You have to capitalize those amounts. All right, assets may be subject to depreciation, which I told you about earlier, but you do not get any type of deductions for improvements of property. And then transactions, it disallows any type of losses between related parties. All right. And it goes on to talk about any other type of related parties and unpaid expenses between related parties. Basically, there's something called arm-length transactions. You're supposed to have the distance between you and the person that you're dealing with. That's related party transactions, arm-length transactions. You should not have related party transactions.
So related doesn't just refer to blood relations, it refers to a friend or...
It's usually blood, but because friends get into contracts with each other, but it's usually related to some type of relationship with blood. But I mean, my mother-in-law and I would be considered related party, and that's not blood related. No. This is what I kind of talked about earlier. Expenses related to production of tax-exempt income are not deductible. I think. Did someone ask that in here earlier about, you asked that, about tax-exempt interest. All right, so expenses related to production of tax-exempt income are non-deductible. So it's kind of the same. Tax-exempt on loans where funds are municipal bonds. We talked about state interest. And then Dr. Payne had several comments made. He drew a $5,000 income. Is that what this one's talking about? No. Oh, okay. This is, yes, he did. He drew $5,000, and it was basically considered. It didn't meet the reasonable test. He doesn't. He took it for himself, and he's his own employee, so it wasn't considered an employment relationship. And then the fine was paid. It was not considered necessary. I think we already answered that. I think we answered all these, didn't we? Yes. Oh, and that was it. Okay. So